you. Thanks, Ella. Thanks very much. It's great to be here. I will begin by going through my slides. But before I do, I'd like to start with this picture. And this light beam that you see in front of you and behind it, you can see London and the financial district in the background, is actually the prime meridian. The prime meridian is the point and the line at which we have set as humans. We've set the longitude at 0 degrees. Now, why is this important? Well, because none of us would have been able to get on this platform, log in at the right time, if it wasn't for the prime meridian. Now, why is the prime meridian such a critical starting point? Because even though throughout human history we have had a number of prime meridians, but since the 1800s, we have had one prime meridian, which is based in Greenwich. Now, without that prime meridian, which allows us to navigate our own space-time, we wouldn't be able to locate ourselves. We wouldn't be able to go to travel, to use our GPS systems. So you can imagine how central that reference point is for us being able to navigate our own space-time. Now, the 17 Sustainable Development Goals have to acquire the same level of importance because that's how we are going to define the content of our experience in space-time. If the prime meridian allows us to define our location, our rotation, our velocity, and our time zones, the 17 development goals have to be understood as such fundamental elements of our guidance system in our space-time. Now, where are we today? Today, based on the recent Global Sustainable Investment Review publication, we have 30 trillion USD of sustainable investment assets. But if we were to compare that 30 trillion number to the actual global wealth figure for the same year, you would find out that we're still at the 13.67%. If you'd compare that total value of 30 trillion to the financial assets across the planet, or even just the regions that are used in the study, we are at 25%. So we have a long way to go, and this is fundamental as a starting point because this leap that the jump that we're trying to achieve into a sustainable future has to be facilitated through the approaches that we currently have, but what we have is not enough to make this leap. Now, in the same review, we have identified 7 overall sustainable investment strategies. Amongst them is ESG integration. Now, ESG integration is fundamentally is an active process that investors engage in, but also it is fundamentally based on the ratings that are being provided to the market. Now, but ESG ratings are actually opinion points. They're not data points. They're scores versus values. They actually reach the market with an interpretation of the data points. Now, this is an issue. Why? Because in an environment that is being digitized intensely, but also a market that is already based on, in some markets, turnover is based on algorithmic trade. More than 70% of the turnover of markets is based on algorithmic trading. It's very hard to see how we are going to expand the pool of capital that is being managed within sustainable parameters if our methodology that is being used for the integration is actually not up to par. Now, we know for a fact that some of these ESG ratings in the market do make use of AI tools and other technological platforms. But the way the natural language processing tools that are being used currently by rating agencies and others, it actually doesn't put the AI in a decision-making role. It's more like the AI tools are being used as assistants to the analysts, which is an issue because it comes back to the same point. Every other data point that is fed into the market today, it is interpreted by traders, by investors themselves. However, when it comes to environmental data, it is somehow packaged in ESG ratings before it gets to the market. So there is a jump, and that interpretive process that is so peculiar and central to the market process, which allows the buy and sell sides to debate the value and implications of different data points, is actually internalized within ESG ratings, which is something that prevents the development of actual algorithms in a market already dominated by algorithmic trading. Now, algorithms, in order for them to work, they need data points, not opinion points. So assuming that we have the data points and all this discussion, and I'm so happy that we have the relevant elements on this panel to discuss the importance of the disclosure of data points directly into the market. Now, assuming that we have the right data points upon which we can build algorithms, we have yet another more serious issue in the current landscape of sustainable finance, which is the fact that our decision-making models, the entire value paradigm of finance, is built on two principles, which are risk and return and time value of money, which serve the mortal risk-averse investor. Now, the entire analytical landscape of finance in theory and in practice, it is built on risk and return and time value of money. That is why the market, even across this conference, we've heard a number of times ESG risks, climate risks. We have to make a very serious cutoff and change this approach and move from risk to responsibility. Climate isn't a risk, and all these issues aren't risks, they are responsibilities. But we cannot change that if our entire financial analytical framework is built on risk and return and time value of money. In other words, our entire mindset is built on risk time, not space time. So to make this jump, we need to not only consider the mortal risk averse investor as a stakeholder, we also need to bring in the bold, responsible species. Because until we do that, our decision-making framework, even if we had the data points, will still not be the right one that we need to make the type of change to do the leapfrogging that we're looking to do. Now, if we were going to build the new framework, what do we miss in that new framework? In that new framework, well, we have a missing principle in finance. In fact, I have proposed this before, but I'm going to focus on it at this moment. And it's what I call the space value of money. We need to introduce a new principle of finance, which I call space value of money. Now, what does space value of money do? The space value of money introduces a new paradigm. First of all, it doesn't compete with risk and return and or time value of money. It complements them. It entrenches responsibility into our mind frame, into our value paradigm, and requires that our value equations are changed so that we can integrate the impact that investments and cash flows have on space, and not just stop at the point where we measure our return and the value of investments based on time and risk, which is the current mindset that dominates the market. Now, to summarize, the actual principle of space value of money is, this is what it states. It states space value of money establishes a spatial responsibility and requires that a pound invested in space has, at the very least, a pound's worth of positive impact on space. This is the general universal principle. Now, there are also metrics that I have proposed to back this, but before I do that, I'm going to discuss the most basic finance equation that is actually still the most basic and yet most important equation that is used and taught across the field of finance. But the mechanics of this equation reveal what I'm actually discussing, the fact that we have a missing principle in finance and that our equations actually fall short of taking in the responsibility of investment vis-a-vis impact. Now look at this equation. This is the net present value equation, which every basic finance student or professional goes through. I'm not suggesting that you guys use this in your portfolio analysis. I'm using this equation as an example to show you how and where current finance theory actually entirely omits the impact that we have on space. This equation misses the impact and yet measures the time and risk value of future cash flows. Now, naturally, I'm not going to go into the equations, but the idea here is that we need these new equations which introduce new data points for our analysis to become relevant and to entrench responsibility in the actual equations that the industry uses. So that's pretty much it. Most of the details can be found already in the document that I've shared in this session, which is called An Algorithm for Responsible Prosperity. So thank you.